I think it's global saber rattling. I think it's silly. I'm delighted to see it happen. Not for mankind or for China or for the United States, but rather for me. I have been investing in rare earths, non-Chinese rare earths, for a substantial period of time, and it would seem that the combined idiocy of the West and China may conspire to make me a whole bunch of money. Normally, circumstances like this don't work, and my suspicion is that the Chinese are sophisticated enough that this is mere saber rattling. It might be that they're not. It might be that the Chinese understand that they have a 5-year lead in rare earths, and what they would prefer is to sell us gadgets fabricated by them from rare earths that they control. If that's the case, you are going to see a boom in rare earth advanced exploration projects and development projects on a global basis. Whatever happens, you will see the price of rare earths increase, not because of geopolitics, but rather because both the Chinese government and the Chinese citizenry are becoming less tolerant of the hideous environmental practices that have occurred in Western China in terms of the exploitation of their rare earths resources. The mining practices that have occurred in the past, and especially acid washing, are really techniques that don't have any place in this century. And mercifully, I think they're being discontinued, which will lead to fairly rapid cost increases in Chinese production. The Chinese did that once before. Whether or not it was geopolitics or common sense is a different question. But the Chinese sort of waved the supply red flag. All kinds of people rushed into rare earth commodities that they couldn't spell or pronounce. The Chinese backed off, cratered the market for rare earths, and there was several billion dollars in exploration and development expenditures that were crushed. You may remember, Albert, the Mountain Pass deposit in Eastern California. You probably drove past it on your way from San Diego, California, up to Las Vegas. That deposit went from bankrupt to a $4 billion market cap to bankrupt again in the same cycle I just described with regards to the Chinese playing volleyball with rare earth policies. I always like lower prices better than higher prices. They delivered a bad quarter, make no mistake. Uh, Mining companies have a habit of doing that once every couple of years. I have a lot of time for Benoit Lassalle. I will say that the share price of Aya assumed that there would never be any bad news ever. And he had a lousy quarter. Let's get to that. I watched Benoit for 15 years build Semifo, and I suffered through the odd bad quarter. But when I look back to the suffering I endured relative to the profits I made, the suffering wasn't too severe. For those people who aren't familiar with Aya, the fact that there's a share price decline gives you a much better opportunity to review the company and utilize the lessons from the real classroom to determine whether or not this is a suitable speculation for you. I think it has to do with your risk tolerance. If you are a risk oriented investor and the uranium price continues to do well, you will likely do better in the near term with uranium energy. Uranium Energy has spent 25 years putting together a portfolio of projects that can be brought into production. The pricing and the financing is in place to allow them to do that now. They will need to take risks, particularly because the market has asked them to remain unhedged and not take advantage of term markets. Uranium Royalty, by contrast, doesn't have any capital contributions to make, which means that you take away an awful lot of the risk. For uranium bulls and people who are aggressive, I think in the near term, you probably stand a better chance of making money with UEC. You deserve it because you're going to be taking more risk. It looks as though they want to put 4 different projects into production, and I haven't seen much with regards to the sequencing. There are several risks with regards to this. One of them is that in the pursuit of too much growth, you foul up a couple of the components. So for uranium bulls that are more risk averse, uranium royalty, certainly, because your gross is your net. For people who follow the uranium thesis, particularly the domestic uranium thesis, uh, the fact that domestic producers have gone in 6 years from being vilified to being subsidized, UEC may be the ticket. I don't see one or two big deposits. I see a bunch of lenticular deposits. Given that I see that, I can't construct a good enough financial model to own the stock. I have a high regard for the people, and I could easily be wrong. My past partner and mentor, Eric Sprott, who I have a huge regard for, owns a whole bunch of stock. I don't own any. I don't own Coeur. I think that the merger provides Coeur needed breathing room with regards to free cash flow. They paid up because they needed the cash and because they have net operating loss carry forwards to shelter the cash, which means that the money goes to Coeur as opposed to the tax man, which I always applaud. This mine has a fairly short indicated mine life if they aren't able to drill off more reserves. So the question is going to be, can Coeur redeploy the cash that they receive from the Silvercrest asset fast enough that when the current reserves and resources deplete, value will be created? I did own Silvercrest. I looked at the combined model of Coeur Silvercrest, and I sold. I needed more data with regards to reserve life than is available. I'm familiar with them, and I need to say I don't know enough to comment. They are exploring what appears to be a very promising concession based on existing data in Northeast Congo, which is a wonderful place to look for gold. Long-term associates of mine will remember with some pleasure the money that we made on Motogold, the Kilomoto gold fields prior to its takeover by Barrick and Anglo. My hope would be that Longcore repeats that, but I need to say I haven't done enough work to comment. Yes, indeed, they'll be focused on paying down debt. Before they do that, they need to get Greenstone to nameplate capacity. They have, quote, economic completion, which is to say they don't need to spend more money on the mine or the mill, but they need to tune things up. It's often the case, well, almost always the case, that when you bring a big mine like that into production, you need to debottleneck the mine and you need to optimize the mill. So it's important to note that while they have achieved, quote, economic completion, they have not as of yet achieved nameplate capacity. Once they do that, they are going to have to pay off a mountain of debt. If the mine operates as they suspect it will, which is to say, as the feasibility study suggests it might, remember that the feasibility study was done at $1,700 gold. The financial performance of the mine at $2,500 gold should be, notice, Steve, I said should be, substantially better than the financial performance that was predicated on $1,700 or $1,750 gold. That being said, there's over $1 billion worth of debt to pay off. And while they were building Greenstone, I think it's fair to say that they probably scrimped on sustaining capital investments other places in their portfolio, which has resulted in some of their other operations generating all-in sustaining capital costs that were substantially higher than had been predicted by the company. If they make Greenstone work, and I believe they will, I know this mine building team, it will spin off a lot of cash. But that cash likely won't see the light of day for 2.5 or 3 years while they repair their balance sheet and deal with sustaining capital investments in other locations. It could be, it has been suggested, and by the way, I suggested it to Ross Beatty in London last week, that as a consequence of completing Greenstone, some of the secondary assets that they used to build the company could be sold. It is consistent with Ross Beatty's efforts over time that you build a company on smaller assets. As you lower your cost of capital and acquire higher quality assets, you sell on the lower quality assets to other people, repairing your balance sheet while at the same time leaving you to lavish more care and attention on your higher quality assets. When I mentioned this to Ross in London, he didn't say anything, but he did smile. Yeah, it's extortion. It's what governments do. It's just that Mali is more forthright about it than the United States or Canada. I'm actually trying, through a couple of friends of mine, to arrange an invitation to meet with officials from Mali, Niger, and Burkina Faso at PDAC. I've learned that if I get invited, I get a better meeting than if I try to invite myself. So I'd like to learn a lot more about these now governing resistance movements from West Africa and learn just exactly how they view foreign investments. I found that meetings like this in the past have been very illuminating, both in terms of good news and bad news. So I'm hoping that I can meet these folks at PDAC. If they say that they'd be happy to meet with me, but that I'd need to go to West Africa, I'd probably be willing to do that. Uh, you know, I would be amused, I think, at those sort of meetings. I remember many years ago in the early 1990s, traveling to Cuba with Doug Casey and meeting government officials, and I have to say it was one of the most interesting experiences in my life, and I wouldn't mind doing that again in West Africa. The meeting is perfunctory and stupid.
Okay.
But usually, if I'm introduced by somebody who knows me and knows them, and there's some suggestion that I have some measure of influence in the mining investment community, I can be invited by these same government officials, and I get treated much better if they invite me than if I invite myself. May or may not work this time.